Yo, welcome back to the channel. Today I'm gonna talk about how to get 10% plus yields from a pretty interesting investment vehicle. So you guys should check it out. If you guys haven't already, like, comment, and subscribe, and we'll get into the video. So today I'm gonna talk about closed-end funds and why you should research them. So first of all, let me kind of get into the benefits, kind of the risks and the warnings people have, and how like most people don't even know they exist. But the first thing that I'm gonna mention is that a lot of these funds are really dog shit. Like, you should stay away from them, but you can't discount a whole sector of investment by just saying, oh look, all of these are shit, because there are some really good ones. For example, if I go ahead and show you here, if my autofocus will do it, as you can see here, I've got a couple, PTY being one of them, one of my favorite. Beats SPY, beats the index if you reinvest your dividends over, say, like 10 years. I'll put up a chart right here to show you guys that, but it's a really good fund and it yields about 9.9%. Paid to you monthly distributions, and I feel like the fact that a lot of people don't know these investment vehicles exist is kind of alarming, but PTY is one of them. The next one I'm going to tell you guys about is PDI. This one, I'm not too sure if it does beat the SPY index. I'm going to put everything right here, but over the last 10 years, I'm not sure. But the benefit of a lot of these funds is cash flow. So if you are able to get cash flow, you free up capital, so you don't have to pull from your principal. Because a lot of people, when they look at compounding over time and they look at the SPY index, or they look at like different kinds of like tech stock index funds, they basically think like, hey, I'm gonna make more money doing this over a long period of time, so I should stick with that. But what if something does come up, and what if you don't want to pull out of your principal? Then you're gonna basically be in a situation where, okay, I'm gonna pull out early, I'm only gonna pull out this much, but it's actually gonna affect your retirement so much more than if you had just put it in fixed income investments such as closed-end funds. Like I said, PTY, PDI, two PIMCO funds I really like. There's RQI, which also beats the shit out of SPY. I'm gonna put that right here. It's a real estate investment kind of closed-end fund. If I'm not mistaken, I will put all of their portfolio holdings right here to kind of break it down for you guys, but it's a great fund. It's by Cohen and Steers, and it's a really good fund. And let me go ahead and take a look at a couple of the other ones. For example, QYLD is another one I like. It's not a closed-end fund. It is an ETF. Basically, it's by Global X, and I believe that their team trades covered calls on the, if I'm not mistaken, NASDAQ index. Yeah, NASDAQ 100 covered call. And they're able to achieve about like 10 to 12% per month at the current prices. And the reason a lot of these yields are a lot higher than what they used to be is because due to the current like coronavirus situation, it kind of like brought all of those stocks down, and it's a really good time to get into them because you're getting these double-digit yields pretty much when they used to be like 7 or 8%. So by exposing yourself to that, you're getting even higher returns on your money. So when 2 to 3 years from now these funds do go back to their net averages of values or whatever they were trading at, you're gonna be able to make like 10 to 20% upside, if not 30%, while collecting that 10% plus yield every single month. But yeah, now I'm gonna talk about something called net asset value, just so you guys know. So there's this really awesome tool called CEF Connect if you're investing in closed-end funds, and it allows you to kind of tell if a fund is trading below its net asset value or above. And basically what that means is, if, for example, say the fund is holding like baskets of securities such as corporate debt from like companies like, let's say, Hertz, Alphabet, like Tesla. One fund that holds a lot of that debt that I know of is CRF and CLM. These are really risky. Just based off of looking at the funds, they get like a 19% yield paid out monthly. But a really good fund that holds that kind of debt from these like corporate companies is called CHW. I'll put a little chart of it up here, and the holdings, and then over here I'll put like the comparison over the last 10 years to SPY. But okay, so I lost my train of thought, but yeah, I was talking about net asset values, and basically what it means is what the assets of that fund are worth. So let's say it's trading below the net asset value. It means it's at a discount to the net asset value, and what that means is that, you know, you're buying it, and say like the fund were to go to shit, you're going to, if they do give you back your money, you're gonna get all of those baskets of securities sold off at that net asset value, and you're gonna get it back. But that's worst case scenario. That's not gonna happen. I've never seen a closed-end fund in history kind of zero out, except for 2008. I'm sure there were a couple, but that's with every fucking recession. But you know, most of them won't. And what that means is if you're buying it below net asset value, eventually it's going to go to, you know, that net asset value or higher once the fund realizes its potential. And sometimes there's funds that don't. Sometimes they're just, you know, they're always trading at a discount to their net asset value. And a special case where it's the opposite is PTY, which I was talking about, which always trades at a premium to net asset value. It's been very, very few times where it's been at a discount, just because the fund and its asset managers are so good that people really want to own the fund. They buy it and they start accumulating it when it goes down, so it's always at a premium, because every time it goes to a discount, people won't let it stay there. So those are the kind of funds you want to look at. If they're always trading at a premium, there's a good reason for that. It's because people like the fund. But yeah, those are a couple. I'm gonna like list a couple like over here by ticker, boom, 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 boom. And you guys can all check them out, and their yields over here. Just give it a couple seconds. Bask in the glory of all of these and their yields per every month. All of these are monthly distributions. I do not invest in anything that's not a monthly distribution, just because I want that monthly cash flow. And yeah, I'll show you guys basically what I'm getting right here, basically per month, and my yearly, you know, cash flow, and my average yield, all right here. But yeah, so I'm gonna keep you guys kind of in the loop with all my investments, what I'm picking up, and different investment opportunities. I've also opened up a recent growth portfolio that I'd love to share with you guys. I'm gonna go over that as well into a couple of the upcoming videos, but I'm looking forward to showing you guys a lot of this shit and making us all rich. You know, 10, 20 years, financial freedom. Anyone can do it. So that's all for this video. If you guys enjoyed it, like, comment, and subscribe, and stay tuned, because a lot of awesome videos are gonna come through. So that's it. Take care. Have a good one. Peace.